Welcome to Livewire Markets. My name is Vishal Tekshandani. Thank you for tuning into The Pitch. Joining me today is Joe Millward, and we are going to discuss private lending, the banks, whether they're retreating from corporate lending or they're not. Joe is going to help us demystify this. Joe, welcome to The Pitch.
Yeah, thanks for having me.
Of course. So Joe, a lot has been made of banks retreating from corporate lending, but you've got a different take. Please share it with us.
Sure, happy to. And it's not just me that has a different take, it's the publicly announced results that the major banks publish that has a different take. So it's interesting that the narrative suits a number of private credit funds. We believe that the banks are retreating because that creates a natural opportunity for them to suggest that they're playing where the banks used to play. But the data doesn't support that. The facts don't support that. Vishal, I've actually brought some data points with me, and anyone can look these up. They're freely available. Pillar 3 results are what the major banks publish to APRA. And just going off the most recent results from CBA and NAB, CBA's corporate loan book, which is the corporate area of the world, is where most private credit funds are playing. That's grown 10% in the last year. It's gone from $160 billion to over $170 billion in 1 year alone. CBA's corporate loan book. NAB, similar kind of numbers, $197 billion up to $217 billion of corporate loan exposure. The banks are not retreating, Vishal.
Okay, so while they're not retreating, there are some limitations on what they can and can't do. Can you share with us what are these limitations?
Sure, I wouldn't call them limitations. I call them shortcomings and restrictions that are placed by regulators. They're two very different things. So the regulators, mainly APRA, set the amount of risk that banks can take and the amount of capital they have to set aside in order to take that risk. That means it's very expensive from a return on equity perspective for banks to pursue certain segments of the market, normally riskier segments. Then there are what the shareholders of the banks and the board of the banks are seeking to achieve, which are improved returns on capital, return on equity, return on shareholder funds. And so if you're a CEO of a major bank, you're going to be focused on cost to serve customers, automation of decision making, simplification of the products that you offer the market. And so banks are more inclined to offer homogenized products and less customized products. They're less efficient at delivering highly customized products and riskier products to the market.
Okay. What opportunities is this creating for folks like yourselves within private lending?
Sure. So Epsilon Direct Lending, we focus on providing loans to medium-sized companies for the purpose of growth. And the banks want to support this segment. They want to fund medium-sized companies in supporting their growth. Typically, these companies are growing through acquisitions. And acquisitions are quite complex to structure for, to lend for. So that creates an opportunity for a non-bank lender like Epsilon to participate in that market. The banks aren't as efficient, as I mentioned, in providing capital to less homogenized assets. Assets like mortgages are easy because there are standardized terms and conditions. Acquisitions are different every single time. And so we compete based on a service, a value proposition, a service proposition to borrowers. If they want efficiency of decision making, they want speed, certainty in the provision of capital, and they want a direct relationship with the decision makers, that's what we offer that we don't think the banks are as good at offering.
Okay, so sounds like there's a lot of value from the borrower's perspective in dealing with a private lender, but you as a lender, how do you manage the risks within your portfolio going through these different stacks of borrowers who are coming to you for capital?
So the purpose of the loans is to support growth, so that's a positive purpose. We're not refinancing an existing loan. We're taking a view on the company's sustainable, predictable earnings after the acquisition has taken place. And we're really unpacking all the risks that might impact the sustainability and predictability of the cash flows that the company generates. And that is what underwrites our loan. It's the future cash flows that we believe the company can generate. We typically partner with private equity firms who will be contributing a significant amount of equity capital, first loss capital, in seeking to acquire the company alongside us when we provide a senior secured loan. So we ensure that those loans, when we structure them, when we execute the loans after we've originated it, those loans have really strong buffers, so strong equity contributions, really strong servicing levels, interest cover ratios, debt service cover ratios, and so on are in place. And then on an ongoing basis, we ensure that we have great access to the company after we've performed substantial due diligence in providing the loan. So we get monthly P&Ls, cash flows and balance sheets from all of our borrowers. We regularly speak with the management team. We regularly speak with the owners of the business to ensure things are on track. And then we seek to assist. And in the most extreme scenarios, use our security positions, our documentary protections to protect our downside when things aren't going to plan.
So Joe, why are private equity deals a good indicator of quality in a portfolio? I'm curious about that.
Sure, so let's first define what we mean by private equity sponsor from our context. These are sponsors that are buying performing medium-sized companies. That's who we deal with. There are sponsors that deal with underperforming companies or larger companies, but that's not our segment. And what they're doing is committing equity capital in order to buy a company. That's first loss capital. And they're seeking to see that company grow through a combination of improvement in margins and earnings, and then potentially grow through acquiring more competitors and expanding into new products and geographies. And so because a private equity firm is putting in equity capital, first loss capital, and we're providing a senior secured loan, they've got a lot more to lose than we do if things underperform. Typically, these private equity sponsors that we deal with, in all instances, in fact, have really strong investment track records. They're supported by institutional investors, and they've got very well established due diligence processes before they make an investment. And when we decide to lend to a company, we have access to all of that information, which helps our underwrite case. And then we overlay our own additional level of conservativeness in ensuring that the company can repay us ultimately. And so contrast that with a non-private equity owned firm, you might not have the same level of institutional capital, rigor around due diligence, professionalism, track record in repeatedly buying and growing companies to support you. And so therefore we believe it's a good indicator of the strength of a company.
Okay, so Joe, you've gone quite deep into your due diligence. You're there in terms of your client inside the books, but how do you find these deals?
Yeah, a variety of means. We've worked with a lot of the established medium-sized private equity firms in Australia over 15, 20 years through our careers together. The three founders of Epsilon, and we've all worked in Australia for quite some time. And so a lot of the private equity firms come to us. We get a lot of repeat business. But outside of that, mergers and acquisitions, M&A lawyers, M&A advisors. There are some intermediaries that source debt financing for companies. They're all sources of deal introductions, origination for us. And we also know a lot of businesses because we've been around and we've lent to a lot of companies. And so you find that shareholders, CEOs, they move around in the industry and they normally kind of seek quality offerings from lenders, and that's why they come to Epsilon.
Okay, Joe, wonderful. Thank you so much for joining me for this episode of The Pitch and educating our audience on what's happening with corporate lending and a bit about Epsilon's process. Really appreciate it.
Yeah, thanks for having me, Vishal.
I hope you found this video educational. Please don't forget to like this video and subscribe to our channel. My name is Vishal Texanani. Happy investing.